this. And yeah. Okay. All right. So yesterday we tried to look at some of the price delivery algorithm, or the different phases or stages that that most schools of traders, especially the smart money, tend to follow as they execute their tradings, which I actually implode everyone, if possible, to try to copy. They are always, not oftentimes, caught in the other side of, in the wrong side of trades when the ways are on a different side of the trade. So it's very important that we actually take them. I think, and I believe you may have a little bit ease, try to minimize, especially if you are doing it in the futures market. It's very important we try to minimize our losses and try to maximize our gains. In a scenario where we are so much into the losing sides, or we're losing more of our trades and then we have a very minimal winning rate, the chances that we may actually be doing a backward movement rather than a forward movement, which is not really good for a trader. Your aim of joining trading is actually intended to grow, right? To grow, make some money from the trading platform, and then go and actually enjoy yourself, or possibly better still, invest in some other tangible investments or item or assets that would be preparing for your aging, yeah? Or also something that will increase on your cash cow, because you may have this as a cash cow, and then you need to increase constantly your cash cow. Besides trading, you need to have an external investment, invest in real estates if you can, invest in land, invest in assets that at least, has value, that will always tend to support you in one way or another throughout this journey as you still live. Okay, so it is very important. It takes me back to what I just told you yesterday, that it is very important that whatever money you make in the business, be it from trading or from community building, try to make sure that you have a percentage that you always cash out, right? Have a percentage that you cash out, right? Just cash it out. If you can possibly save it for a while, to accumulate it to the intended amount you want to possibly do some investment, I mean to put on some investment, do it. If it is possible, withdraw and try to put immediately into something tangible. That is the only way you're going to track through your success and your journey into the trading. At least you will be in position to be contented at the end of it all. If you look back, if you look at the years so far spent in the space and the journey traversed so far, you can sit back and say, you know what, it's a good thing. It was worthwhile that I had to, that I had to make this move. Okay. Yeah. So someone is saying I'm still breaking. Is it true? Am I still breaking?
You're good as far as now.
Okay. Okay. Yeah. So basically, that is very important. It's an advice. Sometimes we tend to forget this. We tend to think we should just be trade. We trade, and we go into a quest of wanting to make more when we are actually not even investing the little we have made. Because the goal is you make money to do something, right? You don't just make money to make it static and, in the wallet. And it is worth with the futures market. You don't make and then think you're just going to grow your portfolio within the futures account. And then before you know it, greed steps in. You want to make more and more. You want to make more and more. Before you know it, you're increasing your leverage. Before you know it, you're increasing your risk. Okay? Okay, the good amount you're risking. And then before you know it, you have actually liquidated everything you made. Then you begin remaining in a state of wishing. I wish I'd put this. I wish I'd withdrawn this. I wish I'd picked this. So all you would have is look into the market, look at the match that has been liquidated, and you say, man, this was bad. So you begin, you begin experiencing some other aspect of a setback, which is not really good. So when you make like $20, pick some 10, put it aside, right? You can transfer in the funding wallet. You can transfer in the sports wallet. Let it be there and don't be tempted. Normally there's a chance that since it is your account, right? You can move in within different accounts and different wallets. And so you sometimes have a tendency of saying, but this is my money. Okay, let me just increase it the other side. Maybe I take another trade and then before you know it, that is actually what is pulling you. That is the trap pulling you the other side, okay? You're being hunted and you find yourself taking back whatever you made. So put aside something. If you want to grow your portfolio, grow it in such a way that you have a percentage, apportion whatever you make. So if you make 20, divide a half, let the half remain and it adds up on your capital. The other half, put it aside. That is your profit from the business. It's just like somebody who sold the shop and, you retain your capital and some profit. Part of the profit you reinvest, you restock, right? And then a little bit of you save it aside so that at the end of the day or at the end of a particular period of time, you can sit back and assess the journey so far with the much you've made. So that way you'll find yourself growing and growing and growing. And personally, that is how so far I've made it. I'm not yet there, right? I'm really not yet there, but at least that is what has helped me move and pushed me, and I don't regret. That's why I'm always appreciative, to be part of, this community, and more so, joining the trading arena. So it's a strategy. Everyone has to have their own ways, but to me, for someone who may not possibly have one, that is my own advice to you. Okay, it's your advice to you. So you need to also think along that. It's good. At least you can always feel satisfied and contented that, you know what, I can see this asset, maybe these buildings, maybe these rentals. You will have that satisfaction and say, you know what, it was worthwhile. Yeah. So do that often and you'll really be amazed. Yeah. So that aside, this one is already asking. Isolated. It doesn't take money in the future. Well, I don't understand. Jibril, what do you mean? Please, but with the isolated, it doesn't take the money in the future's wallet. Oh, okay. So you're actually talking with reference to setting aside a portion. Yeah, it's fine. If that is a strategy you want to use, it is still okay. But just know that any amount or any fund that is on the futures account or futures wallet, there are always high chances of you wanting to engage it or put it into practice. You want to put it always into the market. You're going to see an opportunity in a particular coin. You already have one running, and then you're tempted to say, you know what? Let me again. There is some fun here. Let me get into another trade. And before you know it, you're getting into 2, 3 trades, and just before you know it, all of them are floating, and that is where now you begin wishing. Why? So it's a good practice though. It's good, but isolated, yeah, not bad. Yeah. So let's go back a little here. Now, yesterday when we were looking at the price delivery algorithm, we were emphasizing on you trying to pay attention to some of this critical stages of decision making when it comes to the stage at which the price is. And when we look at the let me just try to share my screen and I pick a coin possibly because I said I would demonstrate it today. Okay. Just a minute. Let me pick this. So when we're looking at the first delivery algorithm stages yesterday, I said I would actually we shall have an experiential view of what that looks like. And I wanna let me just use Bitcoin. Let me use Bitcoin. All right, so you see, like in this market, I know BTC dumped and the market pretty went down, but I want us to look at this. I want us to just have a look at this. Let's look at this area. I'm gonna pick this from here. See this area. I want us to see, okay, let me use even this. Let me just use this. You see scenarios like this. If you look at this state of the market, you'd literally say this is a consolidation stage in the market. You know, the market is ranging, right? This area, if you look at this, after the price dumping from here, from just a minute, let me see with my annotation. Just a minute. I'm gonna try to look for my annotation. But can you guys see my screen? Can you guys see my screen?
Yes, we can.
Okay. All right. So looking for this writing thing. It always disappears. Oh, let me reshare. Always tend to disappear. Share. Okay. So if you look at this this movement, this previous market movement, after the price dumping, see? But even before then, the market first consolidated around there. But we're going to look at that. It first consolidated around there. So meaning within that area, there were so much accumulation taking place. So what was happening there, the smart monies were accumulating positions that set their order. It's like they have placed their order, all right? And there possibly could have been a specific quantity that they were waiting for to be filled up. So after the order was filled up, and then the price went down. So there was an expansion, right? There was an expansion. But amidst the accumulation, we said there's sometimes manipulation. Should the smart monies fail to quickly fill up the orders, okay, due to whatever being available in the market possibly going low in supplies, they're going to manipulate the market. And the manipulation would entail creating a scenario which we call a false breakout, yeah? It will attempt to lure the retail traders, right? And in the process of luring the retail traders, it will be doing two things. One, it will be taking off those possibly who love trading with stop losses. It will taking that stop losses away, collect the liquidity within that zone, and also creating that scenario of a fake breakout will also try to create a deception to the traders, the retail traders who fall victims of a breakout, right? They think that there's a breakout that has happened, but because they really don't know whether it's a true breakout or a false breakout, they're going to jump into the market in an attempt not to miss out. That is now the FOMOing. In the fear of missing out, they want to jump in so that they possibly take a ride as the price is possibly, pumping or dumping. So what's going to happen in that case, as they get into the trades, you find that the smart monies are gonna liquidate them, right? It's gonna liquidate them, and before you know it, the price is gonna go in the reverse direction. So what is going to happen in that case? In the process of the accumulation and then the manipulation stage, it's the most critical area that you need to pay attention to when engaging in a trading. Now, the real deal comes in when there is a clear breakout. Now here, if you see here, after this area, after, the accumulation and the manipulations happening there, as we're going to check on later, the price dumped to deliver to this end, right? The price dumped downwards. Now, at this point, we are experiencing more or less a similar scenario there, that we are at a stage of an accumulation. But within the accumulation zone, there is also manipulation taking place. And to actually look at the evidence of that, if you look at this market, all right, you realize that when the price dropped, this was the low of this trading session, right? Represented by that candle. The low is here, right? So if you were this person who wanted to monitor through how this price is going to fare, how the price action is going to fare within this zone, immediately after this dump, okay, and then you see a movement of this nature, you're possibly going to capture this area, and you're going to capture this area, and then you draw. Now, the intention of drawing is to see how far or how long is the price going to fare within this zone, okay? How long is the consolidation going to happen or the accumulation phase in this area? But in the back of your mind, there's going to be aspects of manipulations in an attempt to gather more liquidity by the smart monies before the price can deliver to the intended direction. So what is going to happen in this case? If you had captured this area, trust me, you're going to see that you have scenarios where there is a lot of fluctuations, that you find that the candle dips, tries or attempts to break either above or below. Now, what is it trying to do there? It's trying to take off, it's trying to grab liquidity that lies above or below those zones, below the accumulation zones, right? A simple example is, you see here, I want us to check here, below here, because liquidity lies below, right? There are also some liquidity above. Now, what these smart monies will do, just let me take an instance of this. If you had captured this, just put on the low. Look, you see what happens most of the times? We always know that once the price, what is this writing thing again? Just share the screen. Okay, let me share. Just to people are sharing their experiences here. You make so much and lose so much. Hey, what is this? Okay, here we are. Okay, so I hope I'm not breaking. Am I still audible?
Very audible.
Yeah, today the network is respectful. That's good. So if people, we literally know, most of the times we know, in us, we know that when you capture, when you're trying to monitor a trend, or you're looking out for entry opportunities, for a sports trader, the best entry opportunity is created around the support zone, right? Around the support area. So literally, it means that if you were this person who was basing on identifying trading opportunities with one thing, first of all, using the support and resistance and possibly confirming it later with the indicator, you're going to draw your support line here on the low of this red candle, right? And then you just extend it to the future like we have done. And the intention is you want to see how does the price react upon approaching your support area, right? That is what you want to do. And then also at the same time, you are going to draw this line, possibly capture. You can put it on the high. Let me just use that one. Let's take the high of that candle, right? Of that red candle. So you already have a reaction, price reaction zone. You're monitoring through how the prices would be trading within these two areas, the support and resistance area. Now, for you as a sports trader, your intention would be you wait for the price to drop around the support zone. Hey man, why is this writing thing disappearing? Come on. Point. Going, yeah? Okay. All right. So you'll be looking out for let me just bear with me. This is technology. So when some of the things disappear, you just bear with us. Okay, we're here. Okay. All right. So disappeared again. Okay, but it's okay. Let me just screenshot and remove since it is disappearing often. Okay, so what you're going to be looking out for, you're going to be looking out for entry opportunities around this zone, around the support, right? So you may want to wait. Okay. So you may want to wait for when the price drops around the support, right? And once you see a confirmation, then you may want to enter. And when you make entry, your target profits, you'll have to try to measure from the entry zone towards your resistance. You're not going to assume that the price is going to break above the resistance. So as you're trading, make sure that you only aim at trading within your price reaction zones. Don't assume, okay? So meaning if you make entry within the support, after confirming that, that successful support, and the price is trying to rise again above the support, you make entry and then target your resistance zone that you've identified. Don't go beyond that. But what I do recommend is, if you're going to take profit, take 3/4 of that movement. Sometimes it may not really reach the resistance zone, but your interest is not whether it reaches the resistance zone or not. Your interest is, how much do I take from this? Whether it goes above or stops midway, I am out. That should be your goal. So, and to do that, you're going to reduce your grid by reducing the TP if the distance between the entry point to the resistance is maybe 2%. You're going to take 1.5. That is literally more of like 3/4 of that movement, such that even if the price doesn't really move exactly or immediately to the resistance line, you are still safe because you'll be out, right? You'll be out earlier. Because remember, even as you talk about resistance and support, you're not literally talking about a line or a specific price. It can be a small range of price movement, okay? It can be a small range. Like in this case, if you look at this, this area, okay? If we were to capture our resistance area other than just the line, for the line, we have identified the candle with the highest high, and we have drawn our line to touch that high of the candle, right? So what is going to happen in this case is, what is this thing? Just trying to see again. I don't like things that tend to disappear. Why? Why are you disappearing? Okay, here we are. So if we're to talk about a resistance, if we're to look at it as in terms of a resistance line, this is our resistance line. We have captured this area. I mean, this point here, the high of this red candle. And indeed, that is the price, 113,446.7. But if you were to take it or treat it in terms of a resistance area, we're going to draw it this way. We're going to capture the open of this red candle and the high of that red candle, and then we drag it the other side. So you realize that we have actually literally captured the entire area. We have captured the entire area. Oh, where's the thing? Okay.
Coach
Right,
Musa,
no problem.
your
Yeah.
annotation is there at the price of 117. That's where your annotation is.
No.
Yes.
This is a different thing. This is a different thing. It is
It's up
disappearing.
there.
I don't know why. It is up, eh?
I'm able to see it here.
Okay, let me first do this. Let me change my theme to white, and I see. Let me remove the dark theme, and I see if I can see it. Is it the thing here? The weight doesn't want me to use it. Okay, it's okay. Since it is you can see it, and me, I can't see it, because this one here, what I'm seeing is this one. This one is a tool. These are different tools. This is a different tool. This one is a different tool. It's a shortcut to something. It's a different tool. So it's not what I want. So the annotation is hiding somewhere. I don't know whether on top or where, I don't know.
Yes, it's on top.
On top.
Yes. When you put okay, just put it there. Let me point it out for you. Okay.
Okay.
Where the 118 price, but on your left side, the 118
Okay. Oh yes, I
yeah,
see it. Okay.
yes, that's where it is.
The thing, yeah, it is really hiding. I don't know why it is hiding that far. Let me see. Okay. And you can't fix it. All right. Thank you. So, you see, we would capture, this is the price, this is the resistance zone. You see all this area. We may realize that this is a zone, this is a price zone, right? It's a zone. So meaning if you had made it, if you had actually made entry from, let's say, around here, okay? After this successful support, and then you see the price maybe rising here, you may literally see this was around 1%. But if you are looking at the resistance line specifically, that is the zone you should have gone to, maybe 1.5. But now 1.5, you see here, the price really did not touch there. It just dropped within the zone, right? Just within the zone, and it had to come back again down, right? So it is very important that if the intended target, if you're using a resistance line and you intended TP after the measurement to that resistance line from point of entry is maybe like 1.5, take 1%. If it's 2%, maybe take 1.3, take 1.4, take 1.5. Because your interest is, you don't want to stay in longer in a trade. Your interest is take whatever you're going to take from the market and you get out. Wait for the next opportunity, take whatever you're going to take, get out. That should be your trading consistency. Okay, you don't aim at 5%, then you stay there for maybe the whole week, right? Because remember, the intention is yes, the 5% can be achieved, but sometimes depending on how the market is, achieving the 5% may even have to take you 2 days or 1 day, right? Or sometimes in a good market situation, you just need possibly a few minutes and you're in 5%. So it depends on the situation, the market situation at that time. So for you, aim at making entry and out, making entry and out. Unless you want to take it long term, you're not in any hurry, then you can, it's fine. You can take the larger TP or possibly pause your trade to wait for a bigger gain. But if your interest is to make daily consistent, then just close a small trade, small profits. 1%, 1.3, 1.4, you're good. All right. So as a trader, that is what you know at the back of your mind that you're supposed to do that. Now, if it comes to the futures, that is where it gets interesting. With the futures, not even futures. Let me even go still back to the sports traders. Meaning, if at any point that you have made entry at, always make sure that drop down, because for a sports traders, you Sharifa, Sharifa, Sharifa. What the hell would you do again? Cement. So for sports traders, whatever point you make entry at or from, your goal should be make entry, but do not forget to create a scenario of taking advantage of any drop in the price against you. That is for a sports trader, right? If you made entry here, if you were to make entry from this zone, just like I said, look at the next area of price reaction. That is where you should establish your margin call drop. Always. Yeah. Hmm? Okay. So are we good? Are we still good? Are we still good? Hope we're trying to follow what I'm trying to say. Are we good? Are we still okay? Am I breaking?
You are initially, but you're fine
Somebody
now.
saying, is it the sound gone? I don't know. Okay. Okay. So, if you make an entry at whatever point you're going to make entry at, don't forget to look at any area of price reaction or any point. If, for example, you make entry at a particular support zone, don't forget that that support zone is just all right. Okay, so I was saying that when you make entry at any support zone, always make sure that you need to look out for the second support zone or support line or support area. From point of entry, the price tries, because of probably manipulation, tries to again go against you and dip below the next support zone. It will find when you have positioned yourself to take advantage of that drop by setting your boat accordingly, right? So meaning, if our intention, if our target was this area that we have actually demarcated, this one here, this is our support line, okay, and this is our resistance line. Now we want to make entry, so we wait for the price to drop within this area, then we make entry. We should also make sure that we look out for any support line or price reaction area below this point here, because this is what we are looking at and we are eyeing at. So can there be any other support zone below, such that in case we make entry and the price goes against us, we know the possible point where it is going to get support again? Because it is at that very point of buying at that zone, we're going to have our floating loss percentage being reduced as a result of the average price being brought closer to the price at which the boat is going to execute that buy order at that point. So meaning you have to look out for the second support. If you look out for the second support, it's going to guide you, it's going to enable you know the percentage drop so that you can set in your board as your margin call drop, right? Now, to do that, that's when you really have to go a little bit behind. You need to go a little bit back in history and locate that point. And to do that, simply, you go back, you try to track back. And let me use this yes, to guide us. Let me use a horizontal line so that we can follow it through and find out any point that is below it and establish our second support. So principally come down behind. This is the basic you can ever do, please. And it's not really that hard. You gotta take it like that. It's basic. My here we are. So you see, following our line, this yellow line, that is where the price actually touched, right, previously. Now, below where this line is, below where this line is, I believe we can see that we have a price reaction zone as well. We have this. we also have this. See, we have this, we have that. If you can check on it, do you see this? That below this line, we are seeing the yellow line. The price also once dropped below and it was supported at this point. Yeah, we shall also see that at some point, the price also had to drop below this zone and it was supported here. So literally you have two key support zones. There's this, and then there is that as well, right? Now, what you're going to do is have this, draw their line there. That becomes your, let me put it as a, let me change the color to be white. That is the first price reaction zone. That, in case the price drops below the yellow one, you know that at the white point is where there's a possibility of the price being supported, is this one here. You see that? Now, knowing that, it means when you come here, even as much as the price will be consolidating, you come here and say, okay, what I'm going to do is it? Okay. Okay, there we are. So you know that what is going to happen here is, you know that in case I make entry here at this point, at any point, okay, let's say here, after the price touching here and you see it is taking off, maybe you make entry around there. You know that the price may dip to this point, back to the same point, or if it goes below that, you know this is the next destination. Here is where the price is gonna be supported. If in case it goes below that, you know this is the destination. So you have almost literally 3 key support zones to establish your margin call drops, yeah? Just in case, right? Now, the disadvantage with this when it comes to a futures trader who actually to take a long position, you're going to make entry there, right? And what you're going to do with your eye at this first support on the yellow line, you're going to say, let me actually establish this zone to the second support, right? Now, the smart man understand that pretty well. They know that there's a likelihood that you have set your stop loss around here. Normally, they look even for the people who love trading, you will agree with me that when you're making entry, you look at meaning. What does the 2-to-1 mean? It means that if the price goes in your favor, right? Let's say you have and you set your trade in a way of in a ratio of 2-to-1. It means your interest is from here to there, it is 2%, right? I'm just giving an example, okay? Then from there to your stop loss is 1%. So from point of entry, if the market successfully goes in your favor by 2%, you make 2% of your $1,000. That will be $20, right? In profit. But in case the market goes against you, all right, and it comes and touches on your stop loss, you're going to lose 1% of your 1,000, which is $10. So that means you remain with a balance of 900. I mean, not 900, $990 from the 1,000, right? You lose $10. That is the 1%. Now, there, you would have cut your loss. Instead of losing everything or the market going completely against you, or you end up being liquidated, you'd rather risk losing $10. But if it goes in your favor, you'd rather make the $20. So it's a win-win. Now, people who actually set stop loss, that is the strategy. So if you love using the stop loss, have a strategy, okay? Have a strategy. Cut your loss. Now, what the smart man is understand very well is that people love using those ratios, by the way. Some go for actually 3-to-2, or some go even in the ratio of 1-to-1, 2-to-2, although that is not the best. But that is it. That is their strategy of, cutting their losses, right? Instead of being liquidated. They would rather save some fund and go to the next trade, because this one would have now failed. What happens here is when the smart man knows that there are people who set stop losses. You see this? To them, to you, it is a margin call drop. You want the boat to take advantage in case the market price drops against you. To a smart man and people trading in the futures, the smart money look at that as an opportunity to take some liquidity off you. Because when you lose the $10, where is it going? Where is it going? Yes, the interest is the dollars goes back to the exchange, right? But the smart money is interested in the coin, the quantity of coin that was worth that $10, because that is what they want to accumulate for their position to fill in. Price should deliver to the direction they wanted or they intend to. So this collecting liquidity, liquidating you makes you release back the coin that you had in custody worth $10. I'm just giving it in reference to this person who was trading 1,000. Now, you're not the only person. Possibly there will be hundreds of people who might have already set in the same way a stop loss of 1%. So they set their trade in a ratio of 2 to 1. Now, once the smart monies manipulate the market in such a way that they cause a slight dump, right? They will cause a slight dump. And then two things are going to happen. They are going to take off the stop loss traders, and two, they're also going to try to take off the panic sellers. The person entered thinking the price is going to go up, and now the person is seeing the market, the price is dipping and just going below the point of entry, and they're going to fear. They're going to fear of losing. So they'll say, let me sell. Let me sell. I cannot afford to be liquidated. Because they did not use stop loss, so they're going to sell it. What are they still doing? They're giving liquidity. They're releasing the coins they had in custody worth whatever amount they had. So in this case, this is a psychology. The people who were at stop loss were taken off here. Below the stop loss, to somebody who had based his understanding on this being a support zone, where if the price goes below, this is the next destination, the person is going to say, okay, I think from point of entry, it has dipped below the first support. It has dipped below the second support. Now it is heading for the third support. Possibly it may even go for the fourth. Let me cut my loss. They sell. And you see what happened to the market in this case? A moment they sell, positions are filled up. Pressure builds up in the market. The market gains momentum. And boom, the price begins going up. And this was the intention of the whales, right? Of the smart money. But because the orders were not filled to the capacity they needed to manipulate in the market in such a way that they could grab some liquidity and then take the market to the direction they wanted. And that's how they trap these people. Does it make some sense? Does it make some sense? Are we okay? Are we learning something? Are we trying to get something? Hey, you guys were not seeing my screen. Oh, yo.
I'm seeing. It makes a lot of sense, Musa. It makes a lot of sense, and it is understandable. Thank you.
Okay. But were you not seeing my screen?
We're seeing.
I was seeing.
You guys were seeing.
I myself was seeing.
We're seeing your screen, Coach.
Oh, okay. Okay, because now someone was saying we're not seeing my screen. That's why. That's why I was now saying, maybe I just talked a lot of everything went in the vacuum. Yeah, but generally, I believe you now understand the concept that with this understanding, if you want to trade futures and try to escape the instances of liquidation, have this at the back of your mind. Know that as you're making entry, be like someone who is moving at night and you're very how do I call it? Which English can I use? Is it conscious or skeptical or what? Like you have it in the back of your mind that matches are moving at night in this middle of the night, right? Alone. Somebody could be following me. Yeah, somebody could be behind me. So I gotta be. You have to put your heads up, right? You have to be alert. You have to know the tricks. You have to have a preparation in mind that in case somebody comes from you behind, you know what to do next. It shouldn't be get you by surprise, right? You don't have to be trapped by surprise. You have to be prepared. Yeah? You just have to be that's why when you have this consciousness, this alertness, right? You are so alert. It's going to help you because you know that as you're making entry, some big man is watching. The enemy is watching, right? There's some enemy who is watching and wanting to take advantage. So he's monitoring you so closely Is what he wants to see what you're gonna do, right? He's looking at your strategy, what you're trying to do, because for it is interested in more than what you're seeing. So they want to take you out. That's what the smart monies will do. They want to take you out. So to be safer, why are you encouraged to have more maintenance margin? Such that even if you see the market is going against you, because you have enough maintenance margin, you won't be moved. The whales or the smart money will hunt in vain. They will trap those whom they will, but for you, you will be safe. All right? Yeah. So just a minute, just a minute, please. Just 1 minute. I'll get back. Okay. So sorry for that small break. Yeah. So I hope we are good. I hope you understand that. Yeah. What I've just shared, I hope you've taken it in, and it will help you a great deal, because yeah, some of the things is very important. Very, very important that you get to understand them, so that okay. So all right, so let's continue. So how the smart monies take people out is just that. So as you trade, I'm talking to my friends who love futures, who trade in the futures market. So just make sure you do that. Make sure you know that those are the things that happen. Now, and also yesterday, as I said, that when the price is breaking, when there's an expansion, the start stage in the price delivery algorithm is going to happen. Remember that the price can deliver in any direction. It can expand in any of those directions. It can expand to the upside. It can expand to the downside. When I said there are things that we consider, and let it just load and I show you. See, in this case, okay, that's an area. Let me just draw something here. If this is our consolidation zone, I mean the accumulation zone here, right? This is our accumulation zone. For the price, for you to know that an expansion is actually happening, because we said expansion is what sets the trend, right? If you're not comfortable in trading in a ranging market, wait for an established trend. Wait for a formation of a trend that should give you comfortability. You know, you should be comfortable to now make entry accordingly if a trend has been fully established. Now, the expansion, when the expansion is happening, this is what happens. There must be a true breakout. There must be a breakout. In this case, if you see this, what about that? If you see this, let me, just a minute. Let me finish this transaction. I'm trying to use some P2P to get some liquidity. So let me just finalize it quickly and then we come back. Let me see. Just do this. Okay. Okay. And I'll be done. Okay. Okay, and I'm done. So done. Okay. Good. Good. We are good to go. Okay. All right. Back. Let's proceed. Okay. So for a true breakout to happen, we said the price must a green candle. If it is a breakout to the upside, that means a green candle should open from below this area. It should open from below here, below your resistance line or area. Let it start from down, let it come up, and let it close above. Okay, let the close be up, the open should be below. Then to confirm that trend, to confirm the breakout, the next candle that is going to open, let it open from there and close above. Let it not come below this line. And in scenarios where the second candle opens from above and tries to dip slightly below, but then still close above, confirm this breakout with the third candle. It means now the third candle should give you a confirmation as to whether it is really a fake one or a break or a true one. That means the third candle must open from somewhere and close above. Then you can be in position to say, I think we're good to go. Okay? You can use 2 candles or 3 candles to confirm. To use 2 candles, that means the first one must open below, close above. The second one, open above, close above, not even come an inch or below the resistance line that has been broken. The third scenario is, if at all it comes below the resistance line broken, wait for the third candle. If the third candle opens above and close above, that should be your confirmation. Have I made sense? Have I made sense? Have I made some sense? Okay. How does fake candle looks like? I'm going to show you. Okay? Just relax. I'm going to show you in real time. A scenario of a fake breakout. Let me see. But I've already explained, but I'm going to check out on the chart and I'll show you. A fake breakout to the downside happens when a red candle, a bearish candle, opens from above the support, close below the support. Then the second candle opens from below the support and comes and closes back inside the support line. This one is a fake breakout. A true breakout should do, a red candle should open from above the support, close below the support. The next one should open below the support and still close below the support. This is a true breakout. Or it should open below, above the support, close below the support. The next one should open below the support. If it dips a little bit back inside, but then later closes just slightly outside, the next one should confirm by opening below the support and still close below the support. That would be also another true breakout. That is in case it is a breakout to the downside, which is going to bring about expansion. An expansion, that means a 100% movement before a 100% movement before the next stage of which we normally call the retracement or a pullback, or what you call trying to create efficiencies in the market, trying to close the gaps. I related it yesterday, a chicken which is hungry. It's it and sometimes skips and steps on others, but when after realizing that something is now done in front there, then it begins coming back to collect the remnants. Yeah. Yeah. So that would be this retracement. The smart monies tend to come back and try to, collect those other liquidity that was left along that massive movement. Okay. So, and these details you can find in the smart money concept. Okay. I believe Brother Emmanuel sometimes talked about the smart money concept. I don't know. But back then, I remember attending one lesson when he was trying to introduce, and I don't know how far that went, possibly, but I believe probably. Let's come and see. Network jammed again. Okay. I really believe that from this concept, what I've just shared on how liquidity hunt is done, or liquidity graph, for my friends who are into the futures market, I believe and I hope that this helps you a great deal, that whatever entry you're going to be making, you need to be very careful. Now, it takes me to how do you best trade in the futures, okay? Okay. So I was saying that I hope this really helps my friends who are into the futures market. Now, the best strategy for you to effectively try to escape some of this scenario of traps. I'm going to repeat this. I said it yesterday in my conclusion, and I'm going to repeat. You try, if you have, let me just come here. I want to use this. And after this, try it. Go and try it out. That is if you really want to make money in the futures. Try to do this. You see, if you have $1,000, yeah, I don't know why I love using 1,000. Maybe. Am I clear? Am I okay? Is my network okay?
Yes, you are okay.
Because now this part is important. I don't have to be. Okay. So you have to divide. There's a difference between wallet management and risk management. The network has started misbehaving. If it continues, I'm going to stop. Continues, I will stop. Okay. I don't know who was calling me. So I was talking about differences between risk management and wallet management. Okay. If you have $1,000, okay, for you to effectively trade in the futures market and try to limit, not avoid, but try to limit losses, you divide this into two. Have $500, have $500. Okay, what you're doing is wallet management, right? Wallet management. Out of this, keep this as your reserve. Go with this into the futures account, okay? Out of this, out of this, okay? Out of this, I know some people may think it will be too small. It will be too small for them. But I'm trying to show you I'm trying to show you something if you want to build a portfolio in futures trading. Out of this, you're gonna have 500, okay? Divided by 2. Again, somebody saying again, you're gonna have 250, right? Somebody saying again, 250. 250 against 250. Don't leave our reserve. We have a reserve of $500. We already have 500 in the futures account. And out of the 500, we're going to divide it further into 2. So we have now how much? We have our reserve 500. We have 250 in the futures account. Now we are going for the risk. The risk, we are dividing this 500. This is our reserve. This is our capital, right? Out of this, we are now going into risk management, right? So out of the risk management, we're going to divide 250, 250. Out of the 250, we are going to set our parameters to take advantage and utilize only the 250. We are going to assume we don't have the 500, right? Let's assume it is not there. This is all we had. Out of what we had, we divided it into 2. So we're going to set our parameters. your multiple 50. So as you're going to set the multiple buying ratio, make sure it is within the 250, right? So out of the 250, this is the 250. For now, you're leaving it as a maintenance margin. The 250 is what you're saying should go into the market. That is what you're risking, $250. You're risking. If it is going, let it go, the 250, right? But because you also have a reserve, a maintenance margin here, all right, you're still safe here. The 250 here, you're going to set the parameters to make sure that it consumes only the 250. It exposes, it only releases, it only risks $250. Out of this $250, you're gonna determine your initial margin, what you call the first buy-in amount. After establishing your first buy-in amount from the 250, the remaining balances will go for the first call, second call possibly, or even third call. But it all should still only be within the 250. For instance, for instance, you have your first buying amount to be $50 out of the 250. It means what you're left with is only $200, right? So if you're going to set the multiple buying ratio, every other time the robot is going to execute a buy order, maybe when it is buying the first call, let it pick a portion of the 250. When it is buying the second call, let it pick a portion of the 250. When it is buying a third call, that is if you set your margin calls up to 3, that means you should also pick a portion of the 250, of the 200. Sorry, should pick from the 200, not 250. Should pick from the 200 because this one was your initial margin. This was the first buying amount. Okay, you had quantity of coins worth $50 as your first buying amount. You were left with the balance of 200. So any other buy that will happen in the future, be it first call, second call, or third call, should take advantage of only the 200. So if it buys all the 3 calls, the 3 margin calls, that means all the $200 is what has already gone into the market. Then you pause there, you wait. You have 250 maintaining that position open. It is your maintenance margin. It is keeping that position open, right? It is now playing around in between, maintaining, ensuring that your price, the market price, does not go to the liquidation price. So there's a difference, a range already created. Now, to make you even more safe, right? You have the 500, the initial reserve. That reserve is what you're going to transfer to back up the 250. So you'll have a total of $750 as your maintenance margin. Maintenance margin ready to keep your liquidation price far away. Now, this is almost 3/4 far away. How do you call it? 3/4? If you have this percentage, let me see. Out of 100, you have 75%. And then you only have 25%. Now, what is the ratio here? What is the ratio? That is the ratio, let me see. 75 divided by 25. What is that? Somebody with a calculation, calculate it quickly. 75 divided by 25. I want to see in the chat. 75 divided by, on the chat, please. 75 divided by 3:1. Absolutely. So the ratio is 3:1. The ratio is 3:1. Do you know what that means? The ratio is 3:1. Do you know what that means? That means the liquidation price is 3 times far away from your market price. 3 times. Very far. Very far 3 times. Very, very far 3 times. If it was in terms of percentage, that means this would be what is that? That would be equivalent to 75% far away from your market price. So that means the liquidation price is so far away that you will have nothing to worry about, especially with your good analysis. So that if the market is now going against you, you're not worried. Because at the end of it all, remember, the advantage of leverage is You know, out of the 1,000, if you choose a leverage multiple of, say, for example, 10x, it means even the $250 we were looking at as being very small, you know, after dividing it, this was from our $500, which we were willing to what? To use as a trading whatever, besides the reserve, which was $500. The reserve was there. This was our reserve. This is what we transferred in the futures wallet. Out of what we have transferred in the futures wallet, we have divided it into two. This is what we risked, okay? This is what we exposed in the market. This is what is maintaining the position open, right? So it means this with the 10x leverage, that means it is still equivalent to 2,500, which is still good money, because if it closes at just 1%, that is $25. If it closes at 2%, that is $50. But at the end of it all, remember, you have literally increased your capital. You had 1,000, but because of the advantage of leverage, you had up to 2,500. Even when you're even more safer, you're even more safer because you have 2,500 and you have 7,500 as a maintenance margin at the end, just from 1,000. So that means if you make $25 from a 1% market rise, the $25 is more than at least what you would have made from the 1,000 if you had entered it directly. If you had entered that trade directly, because 1% of 1,000, that would be only $10. But now you have 25.
All right, sorry guys. I guess we lost him. Okay, he's back.
Gotcha. Oh yeah, sorry. Sorry. You guys will bear with me. This teacher, this teacher, maybe is not effective. Yeah. Maybe.
Coach Musa, we are okay. We understand you don't control the network.
Yeah.
You just need a Starlink and everything will be fine.
What? It's called what?
Starlink.
Actually, actually, I bought okay, here in Uganda there is there's something called a MiFi. I don't know, the people in Uganda.
MiFi. Yeah, okay.
So I just bought yesterday. I was supposed to register it and the system was done, but today I think I'll register it, and tomorrow we may have a more stable network.
Okay.
Maybe.
Hopefully, we bless God.
Yeah. So I also understand that because it tries to so much interrupt the class. So that's why I had to do that. Yeah. Okay. It's all right. So yeah, somebody's asking, does the strategy apply to cross, or it applies to both? Now, for me, I must be honest. Oh yeah, I must be honest. Me, I don't trade on the isolated mode. And I did sometimes back, but I think it to me it limits me and it doesn't give me a peace of mind. That's mod. It's not bad because there I would be more of like trading or with stop loss. Yet for me, I don't want to trade with stop losses. I don't trade with stop losses. So isolated mods is not bad. It's good. If you understand, the isolated mode is good. It is good, but with the bot, I don't like it with the bot. But manual on the exchange it applies. It is good. It's actually good because for there you can actually try to back your margin. Okay, the maintenance margin. You can add it manually, and you're okay. You can relax. But with the bot, the bot does it in a way. So for generally, let me not go so much into the manual. But what I would recommend with the bot, you would go for cross. Cross is good. Okay, cross is good, and cross also will discipline you because with the cross, yes, you don't have to trade many coins, because when you trade many coins, that means you are increasing your risk of liquidation because all the coins that are trading will be looking at the same thing. Like a parents, and you have very many children, and all of them are looking at the small food you're eating. Everyone wants a share. Everyone wants a share. Everyone is looking at the small food in front of you. That very one. So every child wants to have a test. Every child is depending on what you man. That is risky. So here, the cross is better, but it is advantageous if you trade. If you're using it to trade coins at a time, or if you're going to trade two, don't let it not be more than two. But of course, even as you do that, you need to make sure that you have enough margin. Me, I'm always emphasizing margin, maintenance margin. That is where the beauty is in futures. Maintenance margin, risk management, wallet management, just like the way I explained. You wallet management, how you're going to manage your capital, risk management, how much you're going to be exposing, because in futures is more of exposing. It's like somebody who has put his arm. You're inside the house and you put your arm outside. Okay, so such that even if the robbers or whatever is happening out is able to take it out, it is okay. So how much length you're willing to expose outside through the window as your body is inside the house is what we call risk management. Are you going to put the entire arm outside, or you're going to put the fingers, or you're going to put a part of it? So that is the risk. How much are you willing to risk? So that even if it is taken out, yes, you will be hurt, but not so much. At least you'll have a greater portion, safe. Okay, you have a greater portion, safer. Okay, so I'm just relating it so that you know that you're inside the house, you're supposed to expose your arm outside, and it is at night. So how much are you willing to let go? Is it the fingers? Is it from the wrist? The other side? Is it from the elbow, the other side, or it is from the shoulder? So it depends on how you're gonna, you know? So that is just the risk bit of it. So the risk management is very important, just as much as the capital management. All right. Yeah. So I want to ask if it's not better to use isolated mode when you have a small capital, less than 80. Huh. Chijoke. Chijoke, you have a capital of $80 and you want to use isolated. Why don't you now just use stop loss? Because for me it is the same. Yeah. Because out of 80, how much are you willing to risk? And how much are you going to return? Right? What will be your strategy for, how is your strategy going to be on how to utilize the $80? To me, cross would work best for you. Using my strategy, out of $80, send $40 into the futures account. Retain $40 as your reserve, or what we call a backup strategy, as your backup. Out of the 40, divide it further into how many? Into 2, meaning $20. So if it is $20 and you've taken a leverage of 10x, that is literally $200, which is still more than your $80. Remember, it is still more than your $80. So you have literally $200. That is the $200 you're willing to expose, meaning you are willing to expose or risk $20 out of the 80, right? So out of the 20 you're going to risk, you have another 20 as backup, which is equivalent to another $200. Let me just show you this. Let me show you this. Let me share my screen. I want us to try out this, and then possibly you'll either thank me later or you'll say, okay, this was a suicide. So you have $80, right? That is the only money you have on earth. So out of this, you have $40. You have $40. This is reserve. This is what you're willing to let in the market. Okay? So out of this, divide it into 20, 20. With the 10x leverage, this is $200. This is $200, right? So that is it. So you're going to risk $20. So meaning from the $20, you're going to look out for your initial margin, right? Initial margin. Let's say initial margin is going to be $5. $5 with the 10x is equivalent to $50, right? That means you are left with $15 out of the 20, which with the 5x, it is equivalent to 150. If you're going to establish your margin calls, let the number of calls you're going to establish, if it is 3, let the first call, second call, third call, all utilize only the 150, which is equivalent to the $15 only, so that you have this 200 as your maintenance margin. Okay? What is going to keep your position open? Then transfer the 40 reserve onto the futures account to top up on the $20 to make 60. 60 by the 10x, that's equivalent to $600 as your maintenance margin. So you are in the ratio of how much? You have 60 against 20, which you have exposed in the market. Still, that is a ratio of 3 to 1. Very amazing. So work within that. That will work for you. Is that clear? And that is only best if you're in the cross mode. I hope that is clear. Oh yeah, adding margins via the exchange helps to move the liquidation price. That is true. Very true. Very true. Depending on the modes you're going to be using, whether cross, with the cross, you just need to add on the futures account directly, and then everything will be done automatically. You'll see the margin ratio reducing to a very smaller value, If you're using the isolated mode, it means you have to add the fund or the margin directly. And by doing that, you're going to see also the margin ratio reducing. But if you're trading with the bot, I don't encourage you to go and do it manually on the exchange. You're going to affect, you're going to interrupt, you're going to make the bot to have an abnormal operation. And that is not nice. Because when the bot experiences an abnormal operation, even if you are in profit, literally the bot is going to deduct your gas fee. It will tell you that you've made that much amount in profits, but in reality, it is the contrary. Actually, there's a great difference. Okay, because you would have interrupted the operation, because when the bot executes any buy order or executes any transaction, it will record the quantity, and it will also record the position amount. So any interference externally will affect that record, and then it will have an abnormal operation. Yeah. So that is basically answering to that. I think I've answered literally all. Any other that I've not answered? Because I'm about to come to an end. Tia. Okay. Any questions so far again? Any question? Any question? I think I've answered literally everything. How do you apply the risk management in sports too? Now, the risk management strategy in the sports is also quite different. Okay, it's a little bit different because when you're in the sports market entirely, we are not after the liquidation, right? And maybe I will demonstrate. Let me demonstrate that tomorrow to make it more clear, possibly. That is if I don't forget, or if I don't forget tomorrow, I'll try to show you that strategy. But in the sports market, what you need to understand is that you're not interested, your mind is not into the liquidation, right? You're not after moving the liquidation price away from your market price. Here, you are even more interested in making sure that it comes even more closer, but you're not talking about liquidation. You're looking at the average price. That every other time the board executes any buy order, an average price is going to be created. That average price becomes a reference price. It becomes like the benchmark. Okay. Let me just show you that how that happens. Yeah. I'm just going to demonstrate and probably just demonstrate something in the sports market. This is what happens. I'm just going to demonstrate, and I hope you pick a picture there. That if you start your boat, the boat is going to buy at some price, right? This is the price. Now, by buying, the bot is going to do an automatic calculation, dividing the quantity of coins bought with the position amount it used for buying that to establish what we call an average price. The average price becomes like the reference point or the benchmark, which will measure or from which, okay, it is going to be like your benchmark or a reference point where your floating profit and floating loss is going to be measured. It is the average price, not the price at which you bought or the market price. It is the average price established, which is got by dividing the quantity of coins and then by the position amount used for buying that quantity of coin. You're going to have an average price. So the average price is going to be like your benchmark. So the market price will be playing around and between or above the average price. Okay, that's what the market price will be playing around with. Now, what happens here is if this is your average price already, okay, if the market price goes above the average price, you'll be floating in profit. You'll be seeing yourself in profits. If the market price drops below the average price, you'll be seeing yourself floating in a loss. In the floating loss aspect, you'll be seeing, of course, a red color with a negative. You'll see a figure with a negative, but also it will be red in color. That is just an indication that the price is below the average price. If you're into the floating profit, that means the market price of that coin has now moved above the average price. Now, in so doing, you're seeing yourself in the plus and you'll see a negative value. If it is a 8, it will be a plus 8%. That is to show you that the price has now moved above the average price by 8%. And you're going to see the equivalent of the 8% depending on the position amount that is in the market. If it is 1,000, which is on that coin, you'll be seeing the equivalent of the 8% being $80 also there, indicated by the bot. So you'll have plus 8%, and in equivalent, you'll have $80 of your position amount of $1,000. Now, what you're interested in when you're making sure that you're trading in the sports market is how close do I make sure that my average price is with the market price? Okay? You want to make sure that as the average price is being established, the market price should be very, 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 very close to it. Let's say this is our market price. Let it be as close as possible, because the closer, the smaller the floating loss. So you want to make sure the market price is very close to the average price. And how do you do that? The strategy of making sure that you keep your average price more closer to the market price, such that in case the price begins faring in your favor and begins going up, it needs a small movement for you to begin floating in profit. You just need a small percentage. The difference will be very small. In that, once the price begins bouncing back or faring in your favor, as a sports trader, you know you make profit when the market price rises, right? So as it is rising, it just needs a small inch of movement, and then you find yourself beginning to float in profit. That means for it to surpass the average price, it just needs a small movement, and it will go above the average price, and you'll begin floating in profit. Now, for you to do that, you need to design your multiple buy-in ratio strategy. You need to choose a multiple buy-in strategies that affects the average price positively and greatly whenever the bot buys. Right? Are we following? Are we following? I hope it is not too much. I hope it is not. We're not. Is for cross. Does the bot pick the extra margin capital after the intended margin call finishes? For isolated, I have to increase more margin calls and adjust the margin draw for the bot to buy. Jibril, I don't know. You can you show how to add margin to running futures trade? Where? How? From the bot or from the exchange? Kindly help upload this training on YouTube. I think it's going to be shared. Going to be shared. Some of us does not understand wallet yet. I mean, well yet. Okay. Atara. You're still not understanding it? Sorry. Oh, so many questions. Okay, I'll try to check through. Please, do you support bot trading on both bots trading on futures or exchange? Or I don't get it. Bot or both? Victor? Okay. I'll come back. Maybe you put the questions clear enough so that I'm able really to. I don't want to stress understanding the question. I just want to read it and it's spot on so that, yeah. Sorry if I'm not getting it right. But basically, I hope we are understanding the concept up to that point of the spot strategy. If the goal is to move the average price closer to the market price, you want it to be very close. Okay? You want it to be very close. You're moving the average price more closer to the market price. You want the range to be very small, such that in case of any movement above the average price, you're good to go. Now, there are 3 multiple buy-in strategies that you can use, okay, to make sure you take advantage of that strategy. Of at least always ensuring that the gap is as short as possible. There are 3. There are 3. You have the martingale, the strategy upon which the Royal Q bot has been developed, which we refer to as the double up. You would wish to double your position every other time the bot is buying. You want it to buy twice what it bought before. That is the first strategy. Okay? It's called the double up. And that is where the magic is. You have, where is my annotation again? Mopua, are you able to see again? It has disappeared. Oh, okay, I've seen it. So we have the DC. Some people call it the martingale strategy. It's called the double up. Me literally take them as the same because it is the same design of a strategy. So here, you instruct the robot to buy 2 times what it bought previously. 2 times what it bought previously. And it has a very significant effect. Okay? 2 times what it bought. So initially, for example, if the bot had already placed $100 into the market, if it is going to buy next, it has to buy using $200. The ratio has to be 1 to 2, right? It has to be 1 to 2. That is the first buy, right? It has to be 1 to 2. The significance of having it 1 to 2 is that, for example, if you had a floating loss of 5%, for example, if the bot buys twice what was in the coin, this effect of the bot buying is going to reduce the floating loss by a half, meaning you're going to have 1 over 2 of 5%, which will be 2.5%. So it is going to reduce the floating loss by 2.5%. No, not 2.5%, sorry, not 2.5%, not 2.5%, not 2.5. I beg your pardon. It is going to reduce, what is the ratio? If you have a ratio of 1 to 2, what is the total number of, what is the total? It will be 3, right? So you're going to have 1 over 3 times 5%. What will be that percentage? What will be the percentage? What will be the percentage? What will be the percentage? On the comment, please. What will be the percentage? 1 over 3 of 5%. Yo, just divide 5 by 3. What will be the percentage? .6. So the effect that is going to happen, what is going to happen is you're going to have, oh man, what is this again? Sorry. What is this? My thing is, okay, it is here. So you're going to have 1 of 5% being equals to 1.66%. So remember, it was at negative 5%. By you adding twice what was already in the market or what was already on the coin, you're going to have a significance of reducing the floating loss from negative 5 to negative 1.6. Meaning that is 3 times. You've brought the average price 3 times more closer to the market price. But then if you had $100 in the market, right? And then the next time the robot is buying, it is also using $100. This is a ratio of 1 to 1. Now the effect of that on the floating loss or in moving the average price is that 1 plus 1 is equals to 2. So you're going to have a half of the 5%. If it had gone by 5% floating loss, you're going to have the effect of that reducing the floating loss by only a half, which will be a negative 2.5. So you have the average price moved just a half, okay, by a half. The floating loss, which was negative 5, now it has been brought to 2.5, which is slightly closer anyway, because you allowed the robot to buy. If the robot had not bought and you only maintain the $100 and you did not allow the robot to buy anymore, that means the floating loss will remain at a negative 5, which is a little bit far away from the market price. But any moment you allow the bot to buy, it will have a significance on the average price, meaning it moves it towards the market price. It brings it towards the market price. So if you use a ratio of 1 to 1, the bot initially, when you started, picked $100, placed on the market. Then later on, as it was buying the first call, it bought with another $100 position amount. It means it is going to have an effect on the floating loss by reducing it to a half. But if you allow it to buy twice, okay, you put your multiple buying ratio to be 2 times. It means the bot is going to use 2 by 100, that means it is $200. So it is going to use $200. And by using $200, it is going to have a significance of reducing the floating loss by 1 from -5 to 1.6, -1.6%. That is 3 times more closer. Now, if you had made it, you added from 100, maybe you added $400. You allowed the robot to use $400. This is the ratio of 1 to 4. That means a total of 5. So you're going to have 1 over what? Over 5 of your 5% floating loss. You're going to have the floating loss being reduced from -5 to only -1%. That means you've moved the average price closer to the market price 5 times. You get that? So the significance here, the difference here is in moving the average price, and the other one is moving the liquidation futures trading. You are moving you are trying and you're working towards moving the liquidation price away from the market price. In the spots, you're looking at ways of ensuring that you move the average price more closer to the market price. So that's the difference. And in each of them, they have their own unique advantages if you understand the concept. I hope I'm okay for today. That alone should be good to set you. These are just things we are repeating, I believe. I believe some of you, most of you already actually understood these concepts. So if someone is telling me that in the futures, in the sports market, is bad, floating loss, yes, it is there. Floating loss is inevitable, it happens. But then understand something. You go deeper and understand this. And the moment you understand that, you're going to come out, you're going to derive a strategy that will really help you a great deal. Trust me, it will. It's just a matter of understanding this board, understanding the concept on how to apply them, how to relate whatever you see in the market after analysis and putting it on the board. You're going to be a good trader. All right? You're going to be a good trader. All right? Okay. With those, I think there's no liquidation on sports now. Who is saying, who is still asking? Muchamanza. There's no liquidation on sports, okay? There's no liquidation. You only go through a recess period, what we call a floating loss, a moment of waiting. Eh? You wait, it puts you in a state of rest. Eh? You rest. Because in that case, the price, you'll be in a moment when the price is really has gone so much far away from your average price. So you have to wait for it to come back. However much you're floating, there are 2 strategies. You can be trading in a coin that is floating and you make as much money as somebody trading that coin for the first time or who's not floating, even when the coin is floating. That is 1. 2, you can as well make sure that you get out of that floating loss by replenishing the coin. You can either go for a manual replenishment or you can go for an auto replenishment. But with the manual replenishment would require you having a closer look, following up on that coin for some time, analyzing how the market has been faring, the movement in these prices, and then executing accordingly when there is need. And once it sells, your capital is back and you relax. You wait for the next chance, you do that. Like in so doing, it will help you. Depending on what you're going to use, if your intention is to only make sure you reduce the average price, you bring it closer to the market price, then you will go for as straightens, you'll use the sub-bin mode. But if you're interested in realizing the profit as well, and then if your interest, sorry about that, if your interest is to make sure that you retain or you regain back the capital that was injected in the course of the replenishment and the profit realized, you go for the sub-bin mode real-time settlement. But if your interest is only to reduce to move the average price closer to the market price so that you get out of that trade faster, Okay, in your attempt to replenish, then you go for the sub-bin mode. All right, so it's a strategy. Everything has its way. It's a matter of just understanding this bot well, and then you'll do the necessary. Okay, whoever says, you know, there's too much of floating loss in sports, do not understand this concept. Yes, you can really go into a floating loss, but if you have extra capital, you can always be out. It takes you to the wallet management strategy. Okay, yeah, or you having at least some aspect of having extra capital. If you're able to pump it in, you can always come out. Okay, I've just shown you how you can significantly reduce the floating loss, you know, by redesigning your multiple buying ratio. It can happen, my dear. Ladies and gentlemen, it can happen. Floating loss shouldn't be a sickness, right? Most of the people get so obsessed and hungry, and they feel like the world has come to an end when they see a floating loss. Come on, come on, come on. Mm-mm, mm-mm. It isn't. There is a way, always. Okay? Yeah. Too many questions today. Too many questions. Eh, if I want to add like $100 in a trade, should I just buy and add 100 or open the next margin call to pick the 100? My dear, this is Monica. Monica, I don't want you to trade blindly. I don't want you to do things out of like I was gonna use ignorance, but don't just do it. You know, when you're doing a replenishment, have reasons for doing replenishment. Okay? Don't just say because I have this fund, you know, redundant, let me just add on the coin. No. Go to the market. Look at that market. Is it showing a possibility of a move to the upside? If it is, what are the potential movement percentages? Is it going to move by 10, by 5, or 3? Now, then you boil down to what strategy do you want to do as you replenish that coin? Do you want to realize some profit as you do that? So that when you inject this $100, once the price moves by some percentage, it will give you that profit, and this capital as well will be back into your wallet, and you wait for the next opportunity. Or you're just interested in putting in the 100. If it sells at the percentage you have realized and that you have set, it should sell, and then whatever has been used is retained on the coin, but the end goal is moving the average price towards your market price. That can also be one thing. So it depends on what you want exactly to do, what your interest is. Okay? Don't just put it because it is there, redundant. No, that's not how they do replenishment. Yeah. Okay. I hope I've answered that, Monica. Don't just open margin call. You need to, and even as you're opening it, I mean, you must open it in a way that you want the bot to buy at some percent, right? Open it in a way you have a target at a point where you want the price to, the bot to buy, okay, or to put that 100 on the coin. Yeah. Uh-huh. The robot can buy until drop 100%. Most of the time, hit for 20% doesn't count. Chamanza, I'm not getting this. If somebody understood the question, please, maybe you can rephrase it for me. Any of the leaders there or anyone. Okay. Oh, please mention the remaining two strategies you refer to. Hey, I was just highlighting. I don't use the one. The other one is the Fibonacci. The other one is the +1. And then, okay, anyway, that was not what I wanted to talk about. But since you're asking, let me just try it. There is that strategy. There is this strategy. I talked about the double up. Then there is the fib, where you are exactly going to be setting your multiple buy-in ratio following this fib sequence. All right, following the fib sequence. You remember the fib sequence? We talked about it sometimes. You'll have 1, you'll have a 2, you'll have a 3, you'll have a 5, you have a 8, you have a 13, in that order. And how you arrive at a fib sequence, we did talk about it the other time, that you add 2 numbers to get the next, you add the 2 to get the next, you add this 2 to get this, you add 2 to you add 8 to 5 to get 13, you add 8 to 13 to get the next, you add 13 to the next to get the next. So it's you add 2 numbers consecutively to get the following number. That is the fib sequence. Now here, it's also a strategy. And if you can go for that, it can as well work. It's good. It's second to the double up. It has a significant effect as well in moving the average price closer to the current price, and then, or the market price. Then there is the +1, where for every preceding call, you have a 1 added to the previous number, as you get the next multiple buying ratio. Like if first call, you had instructed the robot to buy 1 time, when it is buying the second call, you add 1 to 1 to have a 2. So that means you're going to instruct the robot to buy 2 times. Now, when it is buying the third call, what you're going to set as your multiple buying ratio is you're going to add a 1 to the 2 to have 3. So meaning it is going to be buying 3 times. So it bought here 1 time, it bought here 2 times, it bought here 3 times. So if it wants to buy the 4th, you're going to add 1 to the 3 and get 4. Okay? If it wants the 5th, that means you're going to add a 1 to the 4 to get the multiple buying ratio for the 5th call, in that order. This way is equally good, and it is the third good or best strategy I would recommend. But this other incidence of you having 1, 1, 1, 1, 1, that is no strategy. That is no strategy at all. In fact, you don't know what you're doing. I must say this. Sorry to say this for those who do that, but you don't know what you're doing. You're okay. You're trading. It is good. You're really trading, but you don't have a goal. You don't have a reason for setting like that. You don't know why you are doing that. You just want the bot to buy because your market is going down. You buy. And in most cases, they are the people who take long in plotting loss. Because there's no goal. They don't know what they're doing. For them, they're after this. They drop. I want up to 100% drop. So you want buy 1, 1, 1, 1, 1, 1. So 1 is your language. 1, 1, 1, 1. You come even in here, even on the margin call up, you find people setting the same, a uniform number. 1, 1, 1, 1, 1 pass. Or 0.5, 0.5 up to. Really? You know what you're doing. Oh God. So many people have really not understood this bot, and that's why there are varying understanding and there are varying things happening, different strategies. Yes, to some people it works for them, but come on, borrow a lift from why the bot was set, the default settings of the bot. Try to borrow a lift, try to have an analysis on that. Why do you think the bot came in that manner? This bot is designed in some specific ways, by the way. It is only those who go against it so far away, like you deviate completely away from the intention for its settings. That's when you also get humbled, in a way. But if you deviate but not so far away while maintaining, that strategy built by the bot, man, it will be good. It will be really be good. You won't really you won't suffer so much. You won't suffer. Yeah.
Coach Musa,
Yeah.
thank you very much for that. We really appreciate. We know we can't answer all questions right now. We have another session in 20 minutes. So if we'd all be kind enough to end the session here, and then we can then really appreciate you and the coaches here.
Okay. I'm done. I'm done for today. And be blessed, guys. Happy to have everyone on the call. Royce, it was an honor having you there and moderating. Coach Mo, Brother Manuel, Brother Manuel always goes mute. I don't know whether he just opens the thing and disappears. I don't know. I'm seeing Chedrick Weibo, my brother from Kenya. Happy to have you here. Always proud of you. Proud of you guys all. And yeah, let's keep the hopes alive. I remember Saka Sali used to say, let's keep the Africans' dream alive. So let's carry on. Let's keep learning always. Let's keep practicing. We shall be better. Our time will come. Each of our time will come when we shall finally say, oh, we have arrived. All right. So have a blessed morning. Have a blessed morning. And let's meet, God's willing, tomorrow. And yeah, we'll meet tomorrow. Inshallah. Goodbye for now. And I'm off.